In this video, I'm going to talk about the different financial reporting regimes or the major financial reporting regimes that students in an accounting program would encounter. And uh, the idea here is that there are different set of rules out there for financial reporting. Usually depending on the class you're in, you have a certain set of rules. And I have a little statement here that says, understanding the purpose of the standard setter will help you in remembering the rules. Okay, so if you really think about it, if you understand the why of things, the why the standard setter exists and why those rules are being issued, then I think it helps in understanding more easily the rules in place. So let me give you a little information here. So the classes that I teach are mainly in financial reporting and also in managerial accounting. So normally in the business world here in the United States, when we refer to as the financial reporting function, okay, we're usually talking about the US GAAP rules, the generally accepted accounting principles. And it's really important to understand what the purpose, why these rules exist, right? And this is all based on the Securities and Exchange Commission Act of 33, where we had these rules implemented by Congress. So what is the purpose? What is the purpose? And that's really important for you to understand. The purpose is simple. It's to provide financial information to stockholders, which are the owners, and many other stakeholders, okay? These individuals, the stockholders, normally are not privy to this information because of the setup of the corporate structure, right? The corporation. The stockholders usually are not the ones in management. They are the stockholders or the owners of a business through the form of a corporation. They elect the board of directors, and then the board of directors choose the managers that run the business, right? So stockholders generally are not privy to the financial information. So the rules of financial reporting under US GAAP, part of this purpose is to provide financial information to outside parties. And what's the form that comes out every year? And there's other forms, but I'm just pointing out the annual one. The annual report, which includes a whole bunch of information besides the financial statements and the notes to the financial statements, is the Form 10K. Okay? And if you understand the purpose, then when you read the rules for financial reporting purposes, you kind of understand why. Many of the rules are trying to set a minimum standard of disclosure. So if it's something, I sometimes say this in an extreme fashion. I said, if it's something really pretty, really nice, some performance, some amazing thing, usually we don't need to provide rules for companies to disclose that. They will very easily disclose it. If it's bad things, things aren't going well in the company, then it's for that reason that sometimes we need these rules, these minimum disclosures, so that companies are more willing to report both the good and the bad, right? Because if we only, if companies would only have an option, they would just report the really good things and that would be it. So we need a set of rules like the generally accepted accounting principles that give that minimum disclosure requirements for outside parties. That's the way I think about them. All right, so where do these rules come from? Okay, so Congress is the one technically that oversees this whole thing. This is Congress being the legislative body of the government, which includes the House of Representatives and the Senate. So from there, the Securities and Exchange Commission is tasked with implementing those rules, or I'm sorry, with issuing those rules, and then the Financial Accounting Standards Board is the one that issues generally accepted accounting principles. So, at the top of it all is the government that is overseeing this, but the way financial reporting works in the United States is, for the most part, the Financial Accounting Standards Board is the body that handles those rules, and for the most part, we, as accountants and as a group, we oversee the quality of those financial rules. But sometimes the government has to intervene, right? Some acts like the Sarbanes-Oxley Act and things like that are where Congress steps in and issue requires for additional rules, and that eventually trickle down to the Financial Accounting Standards Board. Okay, so what do we do for financial reporting purposes? We use the accrual basis of accounting for recognizing revenues and expenses, and we partition the company into fiscal years, right? So because of that, sometimes it can get tricky, the partitioning, the cutoffs. And I encourage you to watch a video that I have that says why accounting seems so difficult. And it says it's about period cutoffs. So because of these fiscal years and because of accrual basis, sometimes we got to recognize some revenues earlier or later, depending on what the scenario is. So I encourage you to watch this video after you see this so that you see what makes sometimes the accounting tricky. One of the things, at least. Okay. And then I also have a little side note here. This idea of providing information to stockholders and to other stakeholders, okay, because anybody can be an investor in the future, right? It's a very important function. Like sometimes we don't appreciate how important it is and how it affects the market. So us issuing our earnings, our net income, our earnings per share, it makes a big difference. And not just the earnings. I mean, there's all the other metrics that we issue on a yearly basis, on a quarterly basis, that has a lot of impact in the market. And there's a video I have that explains a little bit of how it is that we see that accounting does matter. Like if we were to issue all this financial information and nobody reacts to it, then why are we issuing this information, right? So in this video of other accounting thoughts, why accounting matters, I explain to you one of the aspects that makes us have a job. And it's because whenever these financial statements are issued, the market takes notice. I mean, things occur in the stock market for these publicly held corporations. Okay, so this is one function, this is one regime, the financial reporting function of a business. Now, the other one that we typically talk about that is very common is the tax reporting regime, right? More specifically, the Internal Revenue Code. And what is the purpose of this one? Well, the purpose very clearly is to assure that the taxes due by a company are being reported and paid. Okay, it's very simple. The government needs an amount of money to function that for the services that we as the public, we as the people depend on. And the function for this is the Internal Revenue Service, right? This is who handles that. So very different purpose than for financial reporting. Look at this difference. The IRS is interested in knowing that you declare everything that you've made so that you can pay taxes on it. And for a corporation, it's the Form 1120, the tax return, right? So when you read the rules of the Internal Revenue Code, they're geared towards this purpose right here. When you read the rules of US GAAP, they're geared towards this purpose right here. So that can help you understand why sometimes certain rules seem weird, let's say. You say, well, why would they want that? Well, in the case of financial reporting, any rule that comes out usually is with the intent of providing minimal disclosures to stakeholders. In terms of the tax reporting regime, any rule that comes out is with the intent of collecting taxes. So given the different goals of these organizations, you're going to see rules that are different. And sometimes they are very similar, but many times they're different, right? Okay, so who is in charge of this? Again, Congress. Okay, through the Constitution, Congress has the right to collect taxes, and it's the Internal Revenue Service, the branch of government that through the Internal Revenue Code is able to issue those rules. Now, the rules for tax reporting are not necessarily on the accrual basis, like we said earlier for financial reporting. Usually these are under the cash basis. It's like a modified cash basis. But the idea is very simple. For the IRS, for the Internal Revenue Service, if you receive cash, then if it's for things that you're making money on, then you should be paying taxes on it immediately as you're getting it. Now, compare that with the accrual basis. You might get cash from somebody like a customer, but if it's for like a future service that you haven't performed, then at that point you cannot recognize the revenue, right? I'm just giving you one quick example. Whereas for taxes, if you receive this money ahead of time, even if you have not done the service, it may be a taxable scenario. You might have to start paying taxes on it. So the idea of it being like a modified cash basis stems from that if you're getting monies, you should be paying taxes on that money. Okay? Usually these are the two main financial reporting regimes that we discuss in your classes in an accounting program. But there's also the rules or non-rules for internal reporting, okay? Managerial or cost accounting. And what is the purpose? Well, the purpose of internal reporting really varies depending on management needs. So many times companies will come up with their own internal rules to check efficiency, to check whether the controls that they have implemented are working effectively. And all these things are based on different rules in general for each company. It depends on what the company's trying to get out of the business, right? Trying to do with that business. There aren't any rules per se. This is all based on what you need, right? And then there's other reporting regimes out there. For, just to give you a quick example, for banks, not only do they have to follow financial reporting, tax reporting as well, right? And if they're, looking inside at performance, they're doing internal reporting. But, banks are also under the scrutiny of the Federal Reserve, and they have their own reporting requirements. And I didn't put in here the purpose, but, think about the purpose of the Federal Reserve with banks, with respect to banks. They're going to request financial reports from banks for the purposes of making sure that banks are sufficiently capitalized. Okay. So given that, okay, the last thing that we want as people that put money in banks is for the banks to close, right? So the Federal Reserve is there to provide that assurance that banks are functioning well. And if a bank is starting to go under, they intervene prior to that bank going under. That way we don't have a potential contagion effect of one bank going down and people start getting nervous or whatever. So I'm not going to write here, but just so you understand, every reporting regime has a purpose that affects what the rules are based on that purpose. So for the banks that I'm talking about right here, there's a lot of reporting on capital structure and capital adequacy. So those rules are based on that. And there's other things, other industries have all the other requirements that need to be disclosed, and you would follow those rules as well. But what's the key here? Why am I doing this video? I'm doing this video because sometimes I see students get confused as to what it is that they're trying to accomplish. When they're in a particular class, they get some of these goals mixed up. And I encourage you to be extra careful in terms of understanding the purpose of each financial reporting environment so that you can better understand what those rules are trying to do, right? And if you do that, I think it'll help you out. Check out these other two videos because I think this is real important, especially this one here. Sometimes we don't give thought as to why accounting is so important here in the United States. The GAAP rules and the financial reporting function, how important it is. And look at that one. The other thing I want to mention here is, just since we're on the topic here, if you work as an auditor, a financial statement auditor, right? If you're working in a public company and you go audit the financial statements of companies, you are considered an external auditor, right? And you're doing auditing for the financial function of a business. So if that's the case, the company that's hiring you to do that audit, and I'm not going to go into details of the rules and this and that, but if a company is hiring your firm to do the financial statement audit, they're welcoming you there because you're helping them make sure that these financial statements that need to go out are in accordance to US GAAP, right? So that would be the role of an external auditor. Now, the auditor that sometimes people talk about a lot of times is the IRS auditor. And this is an employee of the Internal Revenue Service that goes to companies and audits their revenues, right? Their revenues and their deductions and all that kind of stuff. So this auditor is also an external auditor, right? But it's an IRS auditor going to make sure that the company has reported and paid all their taxes due. Unlike the external auditor for the financial reporting function that companies want to have there, the IRS auditor is one that nobody wants to have there, right? Because that could just mean more money being paid. Okay, so keep that in mind. Sometimes we loosely talk about auditors and what they do, and auditors can work in many functions. But understand that if it's the financial reporting function, it's very different than the tax reporting function, right? Okay, this concludes the video on the different financial reporting regimes.